Hello, Oxford family. This is Landon Randall, president of Oxford Retirement and Estate Planning, coming at you today with Tom Siomades, chief market economist with our firm, AE Wealth Management. Just wanted to kind of sit with Tom. He's in town from Kansas today. Sit with him, kind of do a market update, talk about hot topics going on for the rest of the year, and just keep you guys abreast of what we're thinking. So with that being said, Tom, S&P market's up over 13%. Most people, when Trump won the election coming into office earlier this year, we're talking more of a sell-off, flat market, maybe single digits, under 5%. Most economists, market watchers were saying less than 5 if it's positive for the year. And here we are, double digits again, headed into October, and market's up over 13%.
Yeah, so they got their wish, right? Because we were down like 20% in April, right?
Yeah, right.
So there's a lot that was going on. And, everybody, depending on what flavor you are, what side of things are, you got your wish, right? We were down 20% early. The other people that were super bullish about all the stuff that could happen, now we're up 13. There's still probably another, I don't know, maybe 4 or 5%. I could see us getting closer to 7,000 on the S&P at this point. There's just it just seems like a ton of stuff hit the market. There was ample opportunity for people to just kind of throw in the towel, crawl under a rock, and if you did, you kind of missed out, right, at the end of the day. But you have to realize that in the overall scheme of things, if the market's up 3/4 of the time, right, 75% success rate, I keep telling folks, you have to keep playing those averages, right? But a lot of people will turn around and they'll say what? They'll say, well, I'm not the Harvard endowment, right? Can't invest for 100 straight years and not worry about it and see what happens after that. I've got needs and I've got, other, sort of requirements that I need to take money in and out and whatever, but I also don't want to get my money hammered by inflation. I don't want to get my money hammered by taxes. And I think what this year's proved to me more than anything is the value of having planning, right?
Sure.
So, again, I think we probably get another 4 or 5% the rest of this year. There's still stuff that can trip us up.
Yeah.
But, you name it, and we've kind of negotiated it, right? I mean, we've gotten, got over the tariff thing, and that's kind of around, but it's not around.
And nobody's talking about it.
Yeah, nobody's really talking about it. I don't really think we're going to get a deal with the Chinese because they're kind of sneaky that way. They make plans for 100 years. We quibble and quabble over every 2-year cycles, depending on who gets in office, right? So they're going to just try to wait us out. We don't have the same kind of impact on China's GDP that we say have on Mexico and Canada, because we get those guys to kind of do a little tune every time we threaten them. They kind of come to the table and
Sure.
they want to do something. But China's just going to find different avenues to sell their stuff, and they're just going to keep eroding, depending on who comes in office here. They're just going to figure out a way to just kind of stall. And then when Trump's gone, they'll go back to doing what they were doing in the first place. So, that's an ongoing thing. You got overseas stuff going on, right? So you never know how that's all going to play out, because we keep hearing how, they want to end the war in Ukraine, but then, the other day I'm hearing that they want to give longer and intermediate
Tomahawks
missiles to the Ukrainians, which is just going to stir the pot even more. The Russians said they wanted to talk. They didn't, and then they kind of just they just went back to doing whatever they were doing. So they might be another one where they are just going to be shifty about it.
Wait
and see if they could just exhaust Trump. And then, obviously the other stuff, you've got this government shutdown that's looming. I don't think for most folk that's going to make a huge difference. I mean, it all depends on who's defined as essential.
Yeah.
So you're going to get your Social Security check. You're going to get your, military is going to get paid. Post office is going to work. I mean, there might be this here, there, or smaller places where,
Parks are shut down.
Right. So, okay. So, stuff like that. And I mean, okay. And we're in Arizona. I mean, I don't think anybody wants to go to the park right now. So,
it's getting cooler. It's getting
cooler. But
we just had some rain.
Didn't the lodge burn down in the Grand Canyon too? I mean, there's not even a place to stay, right?
Yeah.
So, I mean, look, there's a crisis all the time.
There
this,
is.
right? There's always something going on. A lot of it is blown out of proportion, driven by a 24-hour news cycle, which drives people nuts if you sit and consume that constantly. And what, for me, the biggest thing with that is it basically tells you that, you need to stay focused and think more long-term, because the everyday conspires to get you in a really low kind of, low state
Sure.
where you're vulnerable. And stop and think. Why are these guys showing you all these commercials? They want to sell you stuff.
You're right.
Right.
100%.
And the weaker you are,
fear
right.
sells.
And but if you're in a weakened or say compromised state, you're more willing to buy something that's going to make you feel better in the moment. You know what I mean? And that's what they're planning on. So.
Well, and I look at this year, you had the sell-off, like you said, March into April, right? Pretty good correction there. I don't think anyone thought the market would have recovered as quick as this, and look at where we're at now. It's interesting that you're pretty optimistic that we still may have another 4 or 5% remainder of the year. I'm more of like, hey, markets are pretty fruitful. They're double digits. Can we just ride out the year and stay where we're at? But there's a lot of fear out there with markets being, at all-time highs now. You have gold. Look at gold, over 40% year to date. But again, buying gold now, we get lots of questions about owning precious metals. It's a commodity. It doesn't pay interest. It doesn't pay dividends like a stock or a portfolio can or a CD. It's just what's the value of gold. So I'll touch on that real quick. What is your opinion of precious metals? Because we do get those calls. We always tell clients, no more than 10% of your liquid net worth in any one asset class, whether it be gold, precious metals, or what have you. We're okay owning it. We would prefer physical metals if you're going to do it. But some of the money managers have been owning gold in their portfolios, paper gold in the portfolios, and it's been very beneficial.
Yeah, look, I'm not. I'll go on record. I'm not a huge precious metal person, nor am I a crypto guy either. Right. What I would say is simply this. Right. There's a price to be paid for calmness and a lack of stress. If it stresses you out not having gold and it makes you feel better, I think you should have your hand in that. Crypto's the same thing. I don't know what makes Bitcoin worth $120,000 today and it was worth $60,000 a year ago. I don't know what the dynamic that's driving that, other than somebody else is going to want to buy it from you at a higher price, and eventually you're going to get to a point where somebody's not going to want to buy it, and there's nothing underlying. There's no factory, there's no product, there's no anything under it. But if you want to be part of it, say, hey, take 2-3% so you can have exposure to that. That's fine. On the precious metal stuff, look, the precious metal stuff, I mean, historically, you look at it, it returns about the same as a CD, maybe treasury bill. Because there is this fear, right? At the end of the day, what do you do with it? I mean, if we get to the point where there's governmental collapse, worldwide chaos, I don't know. What are you going to do with gold? Yeah, what are you going to do?
You can't eat it. You can't drink it.
Right,
you can't shoot it.
And you can't wear it, and it's not going to keep you warm or your house, heated. But I mean, and then think about it. At the end of the day, if somebody walks up to you and they've got a firearm, and you've got a little sack of gold, they're walking away with your gold. That's right. So you want to run around like a pirate, and
right.
But I mean, again, there is
a good hedge to reduce risk.
Yeah, there is something to be said. And I don't mean to make light of it, right? But there is something to be said for someone's peace of mind. And when you guys are talking about specifically, we're talking about retirement, right? I think retirement should be a less stressful time than when you were trying to raise a family, when you were trying to pay for a mortgage, when you're trying to, accomplish all these life goals so you can get to retirement. You didn't work your tail off just to get to the end to be stressed out.
Right.
Because that's a huge killer too, right? I mean, people have time, they're sitting around, they're getting stressed out, and that wears on you.
Well, and a lot of the talks all year long have been about interest rates, and Jerome Powell and Trump, going tit for tat and arguing about it. We did finally get our first interest rate reduction of only 1/4 point here last month. Thoughts going forward on that? I think most people the market's pricing in 2 more 1/4 point before year's end. Do you think that's accurate, or the risk of if we didn't get one, markets get jittery?
I think if we don't get the 2, markets will get jittery, right? So I think this first one was so baked in, it was beyond baked in, right? It needed to happen because, and my thought on that was that just a bone that Powell was throwing to get Trump off his back?
Right.
And then going forward, was he going to just say, hey, I gave you the one, I'm just going to hang out? But the language that's come out, and all of these guys that are giving post Fed meeting talk, there is an immense amount of pressure to lower them somewhat. Now, 4 1/4 to 4 is not really meaningful. 4 1/4 to 3 1/2 is going to make a difference, right? So people are going to have to scramble a little bit because the rates you were getting, that 5% CD isn't around anymore, right? So That I think so. We're okay. I think through year end with that understanding. That's the trajectory we're on. Now the question is, what happens after the year, right? Do they persist in the rate cut? Because I think Trump wants to see the rate go down even further. I think he'd like to see it to go down 2 or below 2, right? Now understand that Powell is going to be removed in May. Now he's still going to be on the Fed.
Yeah.
But he's not going to be the chairman.
Sure.
So you're going to have a new chairman, and then the question is, will Powell sort of guide things on this trajectory, or does he give us, another 1 or 2 by year end and just say, I don't care, because you figure, in 5 months, what are you going to do? Fire me? Well,
Right.
He is going to get fired.
Yeah.
So now the question is, well, do I want to be standing on top of this burning dumpster when I get fired?
Right.
Or I'd rather leave it for the next guy. So,
Yeah.
It's going to be interesting because the guidance they gave was like there was only 1 cut next year, which is not significant, right, at that point. But if we get down to 2, then that sort of adds more fuel to the fire of where else are you going to go to get a meaningful return. And we're going to be right back where we were a couple of years ago when, CDs were paying 1% or 0.5%.
Right.
And people are like, I can't live on this. And then the trick is going to be inflation. And I think from an inflation standpoint, I don't think we're going to see 2%, to be honest with you. I think, this 2 to 3% place where we're at right now
Stays long term.
Yeah, and if the economy is growing, and I guess the final Q2 revision was up to 3.8%.
Yeah.
So, if we could keep printing 3+ numbers, I think we could deal with 2.5% inflation.
Sure.
And who made that up anyway? That was a Fed, kind of line in the sand that we want a target rate of 2%.
Right.
Okay, but and I get it. People
They got to stop quantitative easing and creating it then.
right, and listen. At the end of the day, you're going to have people that are going to turn around and say, well, I like the way prices were 5 years ago. Well, that ship sailed. So all you can do is hopefully mitigate the rate of increase. But you're not going to get 2020 prices again. Everything's where it is. So people that are upset about high prices, those are here to stay. It's just a question of hoping that they go up slower. They go higher, but they go up slower.
So, good point. We have a lot of clients, and I bet a lot of advisors and money managers out there have had a lot of clients in this interest rate environment that have been in money markets, CDs, fixed annuities, whatever it is, because we were getting 5%. Before this last decrease, money markets that we use at Fidelity were paying right around 4%. Fed's reduced. Money markets are at 3.8, a little north of 3.8 now, which is still a great rate.
Right.
That's not pushing anyone to say, hey, I'm willing to come out of cash and go into the market, into equities at all-time highs. Not normally my recommendation right now. We're always looking to buy the dips. The last dip came, in April, March into April, great time to buy. You're seeing great returns if you did that. And I would encourage all of you that have money on the sideline as rates are going down, hey, when are we going to deploy that cash? As rates go down, once we start to get a correction, which is 10% or more from highs, you probably want to deploy some of that cash. I'm not saying, hey, come 100% out of cash, but if we need a dollar cost average in a set amount or percentage every month, we can do that. Once you get north of 10%, normally it's taking a chunk and go ahead and buying into portfolios to get that longer range return and higher upside. We're starting to see annuity rates, fixed annuity rates. A lot of our clients will use annuities for higher rates than CDs, safety, and a lot of index annuities with income riders for income planning to get their income where they need to be in retirement. So they're not stressed with the government and market fluctuations on their day-to-day income, right? But you guys anyone on the fence, as we know, we're in a rate reduction cycle now. Any of you guys that are on the sidelines in cash, or waiting to get a CD, go out a little bit longer because rates are going down. Now's the time to start acting before year's end to deploy some of that.
And I don't know how many people have basically what I call refinanced their annuity.
Right.
Those refinance rates were really good, and now they're going to start creeping down as well, right? So there was an opportunity to lock that in. As far as putting money to work, from my standpoint, I get it, we're at all-time highs. But I think a lot of people are comfortable with dollar cost averaging when they're retiring and investing, right? The money goes in every 2 weeks from their paycheck.
Right.
Maybe think about reverse dollar costing, right? So it's like you're looking at market goes down 2%. put a little bit in there. Market goes down another 2%, kind of dollar cost average on the way down rather than waiting for that 10% dip because as you saw in April, it didn't stay there very long. I mean, it was like it came down and just came right back up. But if you had been riding that thing fairly quickly, I mean, it was a month and a half, but that rebound was so steep that to try to catch that is hard. So to me, it's like this bolsters the argument for planning, because to me, it's like you can't just sit around and wait for the market to do whatever the market's going to do, and then you're going to pick up the phone and you're going to say, "Hey, Landon, I want to." No, it's like you need to talk about it now,
right?
And almost like like in the military when you have an op order, right? Like this is what we're going to try to do, right?
Yeah.
And so the plan may not go 100%, but at least you have a plan in place of like what happens if the market starts going down and it's going to go down 10%. I'm going to employ this plan. What happens if it goes down 20? I'm going to employ that one. What if it remains flat for a while? I'm going to employ this. So at least you have these three things. So then the phone call is real easy, right? Because you've already kind of planned it out.
Yeah.
And then you just pick up the phone and say, let's go, Landon, let's go with option 2.
Yeah.
And that to me is again, take some of the stress away.
Yeah.
Take some of the anxiety away for people. That's the way I look at it. I mean, you can always be planning, right? There's no cost really to planning.
Not at all.
Right?
Not
and
at
it's
all.
contingency planning, but there is a cost to lack of execution. There is a cost to panic execution. So that's what you kind of want to avoid, because I think the market's going to continue to be volatile at times, very volatile, right? Because there's just so much stuff going on out there, and we got $37 trillion in debt, right? I mean, that's always a scary thing. You got to worry about taxes. Taxes are a big thing.
Yeah. We just had the tax bill to lock in the rates for the rest of our life, right?
Well,
They're permanent.
Yeah, until the next permanent bill comes along.
Right.
Who knows when that's going to happen? But I will admit it is hard. I mean, think about this. For as much of a slam dunk as you would have thought that locking in those rates versus a 20+% increase in taxes, they literally had to get the vice president to break the tie, and they literally had to twist, cajole, and so it's a hard process. So whoever wants to change that is looking at immense hurdles, right? That's why we didn't have anything since the Reagan years until now, right? Because you need to have that ability to get that thing through.
So you being optimistic about markets and kind of still bullish for years in, do you see any opportunities with different sectors? Is there any bright sides that you're seeing, that are down that you think will bolster coming through the end of the year?
I keep looking at housing, for example. Housing has been really beleaguered. There's not enough housing out there. I mean, and you got to figure that with all the impetus that has been put on deregulating and opening up land and trying to we need the housing.
Yeah.
Right? Basically, people, and you guys here in Arizona know probably better than anyone what happened in '08, right? People just walked away and said, we're not building houses anymore. Vegas, same thing, right? And now all of a sudden, you go through 15 years of a lack of building, and a lot of that, then on top of that, you had all this regulation and all this, wetlands and, toads that needed protecting and cactuses that couldn't be plowed under. So once that stuff, if you remove some of that stuff and put an incentive back, and hopefully you get lower rates, because mortgage rates, and you're too young to remember, but I think a lot of people really think that 6-7% for a mortgage rate is a lot.
Yeah.
And I remember my dad in '78 took out a mortgage, 14%.
Yeah.
So, you kind of have to, find that balance. And the balance isn't 14% and it isn't 2%.
Yeah.
So somewhere in there. But if we can get rates down to maybe 5-4%,
you're right. Just a healthy rate.
And increase the availability of housing, right? So, because one of the other things that's driving things is people that have houses don't want to sell them because they have a low interest rate, right? And so there's no supply. That drives up price from that standpoint. And then when the price is up like that, other people that have money, they don't want to pay 6 or 7%, right? So if you have more houses for sale and maybe the housing market stabilizes and it's a little more affordable.
Yeah, I mean, that's the thing is prices are so high. Rates can come down a little bit, right? But prices, it's unaffordable. So what I see in the U.S. is kind of a shift to more multifamily housing, right? I mean, this is big in other cultures around the world. You see Asia and countries in Europe where, the families stay together in multifamily housing. I think we're starting to see a shift here in the U.S. because prices are so high then the kids, the younger generation, can't get out of the house. That right, where parents are thinking more, hey, can we have a casita? Can we make this work? You know what I mean? And shifting that, and I think that the recent data on the housing market is showing where multifamily housing is up, and then single family housing. You know what I mean? Single family homes are,
Yeah,
are
I mean,
flat.
I think a lot of it. I think a lot of it, though, in my experience with it is if like, so I'm Greek, right? You go to Greece and you see a lot of houses there that have like rebarb sticking out the roof, right?
Right.
And it's like 2 or 3 levels with rebarb on top. There's actually not a finished roof, and they're saying is that the rebar keeps the family together, right? But you better like your family, right? Because what happens is the oldest folks live on the ground floor.
Yeah.
They die. The next generation moves to the
down.
ground floor, and then the youngsters move into the high floor. But the challenge there is that one of the things that we don't have in this country that may be more difficult is that we're a really mobile society. Like there's people that grow up in one, like in Greece, you grow up in the same place, you don't go anywhere. Like you kind of just live in the same town, the same people.
Yeah.
So that makes the multi-generational thing easy. But here, it's like I've lived probably in 10 states.
Yeah.
And it's like,
Yeah.
that's going to be the trick. It's like, how do you get the whole kit and caboodle, that whole caravan on
Sure.
the road to move to, like if you have one breadwinner, for example, say it's, the 50-year-old man and woman, right? And you got a couple of retirees. You got to move grandma and grandpa and all of their stuff. And then you got to make sure your kids stay wherever you're at. And the kids are going to fly all over. But
Different culture.
it does make sense. I think a lot of it is going to be more like ethnic groups that are used to that. But if you're like, third, fourth, fifth generation American, you're moving around a lot. But I think
True.
more volume of housing would help that a lot. This whole AI thing, you asked about sectors, the whole AI thing, look, that's not going to go away.
Yeah.
But it's going to be really chunky, right? Because at the end of the day, we don't know how it's going to look. And then you've got these massive companies that are kind of controlling the landscape.
Right.
And are they the ones that are going to, survive down the road? Who knows? But there's always going to be excitement around that. And, like look at Tesla, for example. Like there's one, a tech company, right, that, what's his Musk goes to Washington and they trash the company and the thing's bounced back, immensely since he stepped away. So there's always going to be opportunity. I think at the end of the day, the challenge is, like, I'm not a real stock picker.
Yeah,
I'm more of an asset allocator.
Okay.
And I think at the end of the day, we keep cheering for value and we keep cheering for mid caps and small caps.
Yep.
And it's really the biggest companies that are making the biggest profits. And I think, if you want to get some sleep, I mean, I'm not saying don't buy a company or two, a stock or two that you like so you could talk about it at the barbecue and, I really like what these guys are doing. But for me, I think the best stock pickers, if you're not in the business, are people who pick stocks from the industry where they worked.
Yeah.
So if you're an aerospace engineer, what that, right, left doohickey does on an airplane and the best company for that, you could probably make money doing that. But if you're a doctor and you're trying to invest in aerospace, good luck.